Hello, everyone. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. And today's our webinar's title is Uncover Money Management and Position Sizing Strategies to Maximize Stock Returns. So welcome, everyone. My name is Shen Chu. I'm the moderator for this session. Now, money management is one of the critical components when it comes to trading. So without proper and prudent money management, we might eventually, destroy or ruin all our equities. So today we are going to look deeper into this topic and how we can, do right position sizing so we don't engage in excessive risk taking in each trade. All right. So disclaimer. Whatever we are going to share in this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. All right, so allow me to introduce our very good-looking speaker today, and he's none other than Mr. David Loh. So David is a trader and managing partner of Xmodeus Trading Group PLT, a consultancy firm specializing in bespoke trading strategies and coaching for private and corporate clients in the equity and derivative market and commodity derivative markets. So he has over 25 years of experience in Malaysia listed derivative industry. So before starting his own consultancy, David held leadership positions in futures brokering divisions of major investment banks in Malaysia. He also served as the president of the Malaysian Futures Brokers Association between 2018 and 2019. As a fervent believer in trader education, David has spoken in seminars and workshops to over 5,000 retail traders on trading on Bursa Malaysia, as well as CME, SGX, and Hong Kong markets. So his work includes live market trading sessions and webinars. So welcome, David.
Thank you very much, Shane.
Yeah, good to see you again.
Yes, wonderful.
So let me hand over the session to you.
Okay, just quickly, let me share the screen. Okay, does everybody see the screen? Okay, so, okay.
Hang on, yes, yeah, now, yes, it can be seen.
All right, thank you. And
yes.
Good evening to everybody. And thank you, Shane, for that wonderful, wonderful introduction. Okay, nice things about Zoom is you can actually apply a filter which can make you look better on the screen. So that's one of those discoveries I had. So, you can remove all your wrinkles as well. Okay, so good evening to everybody and welcome to this session. Okay, this is my third series in this session with Bursa Malaysia, and today and this evening we have a very, very interesting topic indeed, and this is one of my favorite topics, how to uncover money management and position sizing strategies to maximize your stock returns. Very, very important. Okay, one of the things that you find out in this session is for the same type of risk you take, okay, and by varying the different types of what we call position sizing that you see later, you can really make a very big difference in the returns that you do in the market. Okay, so that's what we're going to cover. So let's move on. Also, a big shout out to those joining us from YouTube Live. Hi, everyone there. Hope you enjoy as well. So if you have any questions, do put in the chat group. Okay, and we'll take questions at the end of the session. Okay, so let's move on. Okay, Shane's covered this. Covered this as well. Okay, so this is what we are going to learn today, right? The first and most important thing is learn how to optimize your market exposure. Okay, so one of those things that I actually wish that I've learned in my early days of investing in the equity market, and that was quite a long time ago in my 20s, during the roaring days of 1993. Okay, those of you who are young enough to remember those times, 1993, 94, those were the years that the Bursa Malaysia Malaysia, at that time was the Kuala Lumpur Stock Exchange, had this amazing what do you call that, bull run. Okay, and at that time it was so hot that almost everybody was actually involved in it. Okay, and I, being at that time 20 plus years, okay, a newbie in trading and investing as well, but caught by the heat of it, okay, of at that time the bull market, okay, and of course I learned lessons, very hard lessons as well, lessons which I wish that I've already I've learned, okay, and some of the most important lessons were actually in terms of risk and money management, okay, and I also see some of my friends who have not invested a long time in the market, came back actually 2 years ago in year 2020, you had this huge run up, right, and a lot of people went in and got involved as well. Okay, so a lot of people who are seasoned, I think, made very good money as well. Those who are not seasoned also made a lot of money. Okay, but whether or not you can actually keep those money that you made. Okay, and my friends made a lot of money actually in 2020, in certain sectors which was really booming at the time. Okay, but how many of them actually kept that money or those profits that they made? Okay, and those are the key questions actually into this evening's topic will cover. Okay, how much risk and how much market exposure do you risk in terms of your portfolio size? Okay, and in order to do that, you need to know what are the critical measures in sound money management, okay? And you also need to know how to position size, okay? At the end of this session, I'll share with you some tools and also show you how to actually implement the position sizing so that you can get the most optimal market exposure, right? So these are the three things that we will be covering, okay? So let's move on. Okay, so in terms of looking at money management as part of the trading strategy, okay, so if you consider the three main ingredients of the trading strategy, basically methodology, money management, and lastly, trading psychology. Okay, trading psychology is another session that we will have. I think that's next month as well. So we've covered methodology. Okay, if those of you who join us on the in April, 13th of April, okay, I will have shared with you the methodology to how to find high probability trading setups and how to find market reversals and all that. So for those of you who want to review the session, I think it's already uploaded by LiveCham and also by Bursa. You can check that out for methodology, right? So the last session we had is about the complete trading plan, and today we talk about this very critical subject, money management. Okay, so this is a very important key in terms of the trading strategy. Okay, so let's move on. Okay, so let's talk about risk management. In the first most important thing, and this is something that I learned really very hard in my beginning days in investing and also in trading, is I didn't know how to protect myself. Okay, I didn't know how to exit. I didn't know how to get out of the market. Okay, so those of you and those of my friends who until today are still holding that very special sector that was the darling in year 2020. Okay, basically in terms of looking at this one very important slide. Okay, if there's no slide that you remember this evening, this would be the most important slide. Okay, which is basically good trading or good investments is all about your exits. Okay, basically knowing where to land before you actually take off. Okay, and a lot of times when we get in the heat of moment of trading and investing, okay, we may forget this. Okay, but it's very important because it's basically like driving a plane. So if you're a captain of your trading, or captain of your particular plane in terms of investing, okay, you first of course must have to plan on how to land before actually you take you're up in the air, you take off and you don't know where you want to land, you're in trouble, right? So this is something very, very important, okay, because the most important thing about investing or trading is money is made when you sell and not when you buy. So anybody can key in a trade and buy a stock, but it's how do you exit? Okay, so basically in terms of looking at exits, there are three types of exits. Okay, the first one is stop losses, basically exits if things go wrong, and this is the most important, and this is what is fundamentally lacking lacking in a lot of traders from my observations in the last 25 years in the business. Okay, so if you don't have this strategy, okay, this is something that you really need to have inside your strategy. Okay, the other second one, of course, is profit taking. You need to know when to take profit as well. This is very important. Exit, right? Because if you don't exit, okay, those of you who may have been holding some of those stocks in 2020, if you're still holding it until today, well, no, you also probably don't know how to take profit. It's something that's very important ingredient. And the last one, of course, which seldom talk about, but which is very important as well, is if you exit if the trade is not going anywhere. That means you're basically, when you put money into the market at risk, okay, you're hoping that the money will work for you, right? So if it's staying there in a particular stock that is not moving, then perhaps you should actually think of where you want to redeploy your resources or your capital, rather than having it in a particular stock that doesn't move. Okay, move it or adjust it to another stock that is moving, right? So there is also another question that get asked a lot. Okay, those a lot of investors that get stuck in particular portfolios or in particular stocks that may not have or has very little chance of ever going back to those levels that which were first initially purchased. So a lot of people say, what should I do with it? No, I'm sitting on this for years. Okay, some people are sitting on it for 20 years, right? So what to do, right? So you also need to consider this last exit, which is exit if trade is not going anywhere or will not go anywhere. Okay, this is a very important consideration as well in terms of holding those stocks that basically may not ever move back to those levels that you went in with. Okay, so this is what we're going to talk about. Exits is very important, and of course the most important exit is this particular exit, which is the stop loss. Okay, so this basically, the stop loss is like your airbag. Okay, so these days if you drive, okay, every car is mandatorily, I think, equipped with airbags. Okay, very important. Okay, so the key thing is in this very capitalized first bullet point is do not trade if you do not have a defined stop loss strategy. Okay, so every time you do a trade, I said, if you have analyzed a trade, you want to go into a particular stock, you need to know what sort of risk you're going to take for that position. Okay, and those are the fundamental foundations of risk and money management. Okay, those are the very important thing, because stop loss defines your risk. What is the risk you're willing to take on that trade? Okay, and this is the starting point. Whilst knowing that particular measured risk, okay, and then you use that particular risk to count your position exposure. What sort of exposure can you afford to go in? Okay, can that particular risk that you want to take or anticipate to take, okay, can that be what do you call that, suitable optimally for your portfolio? Okay, so this is a very important starting point. Okay, not only in terms of surviving in investing and trading, but also as a key component of risk money management and also position sizing. Okay, so one of the things that need to understand about stop loss is, why do you have a stop loss? Okay, because if you're an active trader, okay, especially in equities, a lot of Malaysians love to trade stocks, right? If you are an active trader, okay, I think the first most important realization is, of course, everybody accepts this, right? That not all trades will be winners. Okay, so you can't be every time you buy a stock that become a winner, right? So I think instinctively everybody knows that, whether they admit that or not, okay, depending on the ego, whether you can accept that or not. But I think this is needed as a first acceptance in terms of trading and investing, that not all investments we make and not every single stock we buy will turn out to a winner. Okay, even the professional managers, okay, recognize this fact. That's why they have this point of diversification, right? So diversification is basically spreading out your bets so that, in case something bad happens to one particular stock, the rest are still doing all right. So even professional managers of money understand this very important principle. Not every stock or every trade will be a winner. Okay, so what the stop loss does, or what this airbag does, is it protects you. Okay, that's the purpose of an airbag. It protects you from fatal accidents. Okay, so stop loss actually preserves your capital, okay, for the winners that will come. Okay, unless you have very bad luck or you really don't know what you're doing, okay, every time you go in, you buy a bad stock. Okay, so that one different different sensei or different guru you have to go to. Okay, but if you are active trader, you will understand that there's stocks that you buy that will go up as well and perform as well. Okay, so you need to preserve for the capital for the winners that will come. Okay, so if you look back, okay, if your experience where you started trading in year 2020, or even some of you may be more seasoned than that, you traded years ago. Okay, if you look back and you reflect, okay, some of you may have that experience, and I had that experience myself as well, is if I did not preserve my capital, when the opportunities come, I will not be able to take advantage of it. Okay, so those of you perhaps thinking over the last 6 months, okay, or last 1 year has been very challenging for equities. Okay, so now what? In July, in coming to August, now is the market going up again? Is the market turning around? Okay, now if the market is actually going to turn around for the next 6 months, do you still have the capital to capitalize on those opportunities? So this is very important. That is the main purpose of your airbag, is to make sure you're still there. Okay, your capital can be really mobilized for the opportunities that will come. All right, so this is very, very important. So in terms of trading, okay, always put in that stop loss. If your platform allows you to put a stop loss, always put in a stop loss every time you enter the market. Right, and because you enter the market with that stop loss, you obviously know where your exit is, okay, before you enter. So you must know where you exit before you actually enter the market. Okay, so in terms of stops, okay, a general guideline, okay, in terms of the risk you take per trade, okay, usually the advice guideline is between does not exceed 2 to 5% of your total portfolio value. All right, so that's stop loss. Okay. And when you have stop loss as well, okay, this is something that also I need to talk about. Drawdowns. Okay, what are drawdowns? Drawdowns are basically drops in your equity or your account balance as you continue your trade. Okay, so every time you trade, because there will be probably a series of losses. Okay, and sometimes in the beginning when you start, okay, you may do well, and then there are a couple of losses. Okay, and the key is to be able, okay, through risk management and money management, to be able to go back up. Okay, so instead of having this downtrending, what do you call that, account size. Okay, this is account size on the left, and this is a number of trades. So as your number of trades go on, okay, you should be able, if your system is decent and has a positive expectancy, something that we spoke about in the previous session, then you will expect, as you continue to trade, okay, you will have this upward trending equity curve, okay, or account balance. Okay, so you will have your drawdowns, this down move. Okay, you have maybe a string of losses, and then it moves up again, a string of losses, and move up again. Okay, so in terms of trading as well, there are cycles in the market. Okay, some cycles are favorable for the equity market, some cycles are not. Okay, so just as you've observed over the last perhaps 2 years, you've seen all those cycles, different sectors, different types of stocks. Darling stocks could turn into non-performing sectors could actually become darling sectors as well, right? So this is something which is a fact of investing, and drawdowns are indeed a fact of life in trading. Okay, so basically in terms of looking at drawdowns, if you want to calculate drawdowns, of course, basically you calculate from the peak to the trough. Okay, and then you measure drawdowns that way. Okay, I won't go into too much of measuring, but I just wanted to stress in terms of the reality of trading, there will always be drawdowns. Okay, it's an inherent part of trading. Right. So in terms of drawdowns, actually, whether you can handle the drawdowns, that will define whether you are a trader or an ex-trader. Okay, because this is the pain part. This is the pain part that nobody likes in trading or investing. Okay, there are the periods that you will lose money. Okay, so in those periods, those drawdown periods, risk management is absolutely the most important thing to make sure you can survive through that drawdown. Okay, and in terms of that, I want to emphasize one thing which we spoke about the last session: capital. Okay, if you don't have enough capital to invest or trade, it can be a challenging, It can be very challenging for you to make money in the long term. okay, because number one, later you see it's very difficult for you to position size, okay. So capital is very important, and of course this proper resizing is crucial, which is something that we will talk about afterwards, okay. So being able to handle these drawdown periods is where you will separate between the successful traders and also the ex-traders or no longer in the market, okay. So basically just complaining that, you know, you should have ever got into the stock market as well, okay. And it could be true. Some people are not cut out to be trading themselves, okay. So in terms of investing, they may leave those investments with the professional money managers or portfolio managers, okay. Not really. I mean, it's something that we have to accept, that not every could be cut out for trading themselves, okay. Okay, so I want to emphasize this particular thing and contrast trading versus gambling. Okay, so in terms of trading and gambling, okay, when we are trading, we are of course taking calculated risk, and this is something that I emphasize in terms of the system expectancy. Okay, so when you're trading, you have a positive expectancy. Okay, so in terms of gambling, of course, it's uncertain, and if you are gambling, then with an establishment, okay, and the establishment will have a positive expectancy, which of course you will have a negative expectancy in the long term. So for trading, okay, the similarities may be the same, short term to medium term, gambling also short, okay, in terms of the trading time, okay. So this is the main point: positive expectation or long term negative expectation. So if you are a long term, what do you call that, gambling, okay, or your system has a negative expectation, then actually your system will actually put you in the face, or rather on the right side of the table, which is it's like gambling. So if you don't know your edge and you don't know that your system, whether it has a positive expectation, okay, so sorry to say, you may be on the right side of this particular table, okay, because you have a long-term negative expectation, okay. So this realization is this: now if you know what you're doing, okay, you will need to really measure your system's expectation, or the system expectancy, okay. We will cover a bit of that and how to do that later, although the formula we have covered in the previous session, okay. So in trading, of course, you have very specific purpose, okay, and the intent, of course, being ahead in terms of returns at the end of the month or at the end of the year, okay. So for gambling, a lot of people may think that, yeah, I also go there for a very specific purpose of making money, okay, but a lot of them are actually playing for thrill and recreation, okay. They are, of course, professional gamblers, they are professional poker players as well, okay. I'm not saying, but those are different league of people, right? So a lot of people who go into the market, okay, even in the stock market, okay, if you don't know what you're doing, basically in terms of definition, you're gambling, okay, because you don't know what you're doing, okay, you don't know your expectancy, okay. Some of you are going in for thrill or recreation, okay, so too much time in hand, MCO, too much time, and then go into the stock market. You are defined as basically gambling, okay. So in the long term, if you're not serious in trading in the markets, it's best to leave your money to the professional managers, okay. But you're serious, I guess all of you who have sitting down, spending your time tonight, you are serious about your trading, okay. Okay, next, let's see what we have. Okay, so trading and risk capital. Okay, this sounds like I always want to talk about this again and again. It's very, very important. Always trade with capital you can afford, okay, which is true risk capital. Okay, why do I emphasize this so much? Okay, because in terms of looking at trading psychology, which is the next session that we will have, okay, and among the experts and I've engaged together, okay, basically if you are not trading with a true risk capital, that means you're trading with scared money that is a fearful money, okay, there is no cure for it. Sure lose, it's a sure lose thing. That's why I emphasize this. If you are not trading with true risk capital, that means with money that you can afford to lose, you're sure to lose. Okay, you know, so I'm very unfortunately to say this, but in terms of the trading psychology, you must trade with capital that you are comfortably able to put at risk. Okay, very, very important point. Okay, so don't approach trading like a money or a game or gambling. Okay, trade it like a real business. Okay, it may be a part-time for you. Okay, maybe you are not a full-time trader, but you're part-time even part-time investing in the market or part-time trading, you need to treat this as a real business. Okay, this is very important. Okay, so very important to increase your odds by having trading a sound methodology. Okay, which I've shared with you one as well. You can use that, or you can search for other tools or other technical systems you can use, but always trade with a sound methodology. Okay, which can give you the trading edge. Okay, so again, I say this trading edge. Okay, if not, if you are going in the market, then must remember, if you whatever money that you lose is the money that the other traders make. Okay, so this is something that's very, very important to understand. Okay, so in terms of risk and risk management and capital, these are the things I want to emphasize. Okay, so now let's get into the gist of it. Position sizing strategies. Okay, this is a very important thing. And before we get into it, okay, this one book that I like to, this one book that actually got me into trading. Okay, this is after that big boo-boo that I did in 1993. Okay, I didn't trade in what do you call that successfully, but I learned a lot of hard lessons. And I also read this book that got me into the business as well. Okay, inspired me. Okay, and a lot of good lessons. This book by Jack Schwager. Jack Schwager has written more books. This was his first book called Market Wizards, which he interviewed all the successful traders and money managers and fund managers and tried to find out actually what were their secrets. Okay, so he spent a lot of time digging out information, and that's why this book is so worthy of your read, because there are a lot of lessons inside this book. Okay, there's other books like Stock Market Wizards as well, which I encourage you to check out. Jack Schwager's full portfolio or bibliography of works that he has. Okay, so this is what started me. Okay, and these are just basically a list of all those people that actually traded and make me that he was interviewing. Okay, so of all these traders, you see a lot of them different type of traders. Some traded futures, some traded stocks, some traded T-bonds. Okay, some traded multiple markets, derivatives and equities. Okay, and basically some are professional managers as well. So what is the actual secret? If you read this book, you'll find that the common thread among all these very successful traders is money management. Okay, so let's go into money management. What is money management? What are the concepts that you need to understand? Okay, so in terms of the last session we spoke about system expectancy, and we measured two things. The first is the win-loss ratio, basically the percentage. What is the average winning trade divided by the average losing trade in terms of dollars? Okay, in terms of the ringgit. Okay, so that will define your risk-reward ratio. Okay, that means every time, say, you risk a ringgit, okay, what is your expected return in terms of that? Okay, so when you divide your average winning trade divided by average losing trade in terms of ringgit, then you get what we call the win-loss ratio. And the win-loss ratio of 2 suggests a very robust trading system. That means if you make 2 ringgit for every 1 ringgit loss, okay, later we'll see an example, then it's a very robust and a very sustainable system if you have this measure. Okay, the second measure is a percentage win. Of course, a lot of people like to measure. That means that out of say 100 trades, how many of trades are winners? Okay, so a lot of people say, wow, I love to have a system that is a 90% winner or 90% winner. Okay, so in fact, a lot of people have very unrealistic expectations when it comes to percentage win. Okay, so in terms of even the top traders, okay, anything between 40 to 60% win rate to them is an extremely very good percentage win or profitable percentage. Okay, so they do emphasize again on this first particular measure, which is the win-loss ratio. So the average wins over the average losses is a very important measurement. Okay, compared to percentage win. Of course, percentage wins is not to say not important. Okay, but seriously, you can even get a winning system with the percentage win below 50%. All right, so these are the 2 key measures in terms of what we saw in system expectancy. The other thing that we can measure also is profit factor. What's profit factor? Profit factor is basically all the gross winning trades, what's the amount of money, divided by the gross losses in terms of the losing trades. Okay, so if you can get a profit factor of 1.5, then it suggests, of course, a very robust trading system. Okay, so this is one of those measures as well. Okay, and the fourth key concept is position sizing, which is a very important thing that we want to talk about tonight, okay? Which is how much, how big, how much to risk, okay? If you have 100,000, how much should you expose to the market, okay? Should I put everything into the market, okay? Or should I bet 10% in the market, or 2% or 5%? So this is the key what do you call that thing in your money management strategy, okay? How much capital is at risk on a particular trade, okay? This is the key thing that will make the difference, okay? So let's run through an illustration, okay? So suppose we play a game, okay? Some of you who are familiar with my sessions, we have seen this, okay? This is my favorite illustration. Basically, you take a coin, okay? You flip it 100 times. This is a trading scenario illustration, okay? So if we accept that when you throw a coin, the odds are 50-50, they will turn either head or tail, okay? So each time you coin lands, so somebody walks up to you and say, hey, sir, you know, let me offer you this game, okay? So this game is like this. I'll flip the coin 100 times, okay? And each time it falls on heads, I'll give you 2 ringgit or $2, okay? And each time the coin lands on tails, you will lose 1 ringgit or $1. Okay, so that's the game. So we'll throw it 100 times. Okay, and suppose the probability, so we accept the probability of heads or tails as being 50-50. Okay, so what is the result after 100 flips? Okay, what do you think is the result is after 100 flips? Okay, if you lands on heads, you win $2. If you lands on tails, you lose $1 or 1 ringgit. Okay, whatever measure of currency, right? So after 100 flips, 50 flips will turn on heads, right? Which is basically saying that those are the odds. 50 flips lands on heads, okay, which is a 2 ringgit, $2 win for you, multiplied by 50, because 50 occasions you made that is $100, 100 ringgit gain, okay? Just for what do you call that? This is for illustration, right? And for 50 flips on tails, which is the opposite, okay, you lost $1 each per flip. Okay, so makes it a $50 loss because you lost $1 for 50 times, right? So at the end of the 100 flips, what is the net gain? You have a $50 net gain, okay? So if you were given an initial sum of $100 and you put, say, $10 on every flip, okay? After 100 flips, you would have made $500. Okay, or 500 ringgit. So which is, if you were offered this game, would you play it, right? How many times would you play it? How long would you play it? Okay, I often ask this question, okay? So if a lot of people say, hey, I would continue to play 100 flips, okay? Every 100 flip, I get 500 ringgit. Or why not? That's a very good income. I play it every day, okay? If this guy is willing to give me this game, okay? So the question is this a good deal? Or can it be better? Okay. So one of the things that you will realize is any guy that walks up to you and play this game, if he knows what he's doing, basically anybody can offer this game doesn't realize the danger of this game. What's danger? The danger is the person that offers you this game. If you know how to play this game, he can lose a lot of serious money. Say, hey, serious man, $500 anyway, every 100 flips. Okay. So how can this guy lose a lot of money? Okay, let me show you how this guy can lose a lot of money. Okay, so let's move on. Okay, so this is what we do. Okay, instead of putting $10 per flip of coin, okay, there are 4 different persons here. Okay, maybe one of them is you. Okay, A, B, C, Mr. A, B, C, D. Okay, each of them have a different strategy. Okay, so A now, wow, okay, smarter now. Instead of a $10, but he actually put 10% of on every trade, 10% of his total account size. I mean, in his pocket, how much money left? You put 10% of that. Okay, so B will be, wow, B is more aggressive. He puts 1/4 of whatever he has in his pocket on every flip. Okay, C is even more aggressive, 40%. He got $100, he will put $40 on the trade. Okay, and D even more. He's more than 50%, more than half of his money in his pocket. He will bet on it on every flip. Okay, so what is the result? Okay, so let's look at the result. Okay, so for A, after 100 flips, his $100 will turn to 4,007. Wow. Okay. So the guy that offered the game is now, wow, seriously losing some real money, right? Not only $500 dollars. Now with this strategy A, he can lose 4,007. Okay. What about B? Okay. So what B after 100 flips? What it is? After 100 flips, B $100 will turn into 36,000. That's why I say if you know how to play this game, you can actually almost bankrupt that guy. Okay, so what's the bankruptcy threshold? I don't know, I forgot already, right? But I think it's slightly around this figure, right? 36,000 he can lose, just offering you this coin game. Okay, and C, after 100 flips, 4,700. Okay, so risking a bit too much also, you won't be optimal. And D, after 100 flips, actually go down to 31. He's only got $31 left in his pocket. Okay, so as you can see from here, what this guy is doing, what all these four guys doing is position sizing. They are position sizing. That means every different flip, there's a different position size. Okay, and the percentage of what they risk out the capital has a very, very significant result in at the end of the game. So as you see in this particular game with this kind of calculations, the optimal is 25%. Okay, now that doesn't mean that you should go and risk 25% of your total portfolio every time you trade. Okay, this is basically based on this percentage win and also the win-loss ratio of 2-to-1. Okay, but what we can learn is this: by varying the position size, you have very, very different results in terms of maximizing your returns. Okay, so that's why position sizing is so important. Okay, and this particular formula was actually presented in this very good book, which I recommend for you to read. It's kind of difficult reading this particular book. Okay, but this is one of the very first mathematical models that were presented in terms of money management by Ralph Vince. Okay, also during those times, the early 90s as well. Okay, you can have a quick check and read this book, Portfolio Management Formulas by Ralph Vince. Okay, check it out by John Wiley and Sons. He presented this particular scenario, okay, in his particular book. Okay. So in terms of looking at position sizing, now what we realize is a proper money management system can actually turn a mediocre system into a winner. Okay, so that's in terms of maximizing your returns, even though your system may not be that great, but if you have good money management or position sizing, you can turn it to a winner. Okay, so in terms of talking about position sizing, it's two principles that you need to remember. Okay, these are the key principles. Okay, one is martingale and one's anti-martingale. Okay, what is martingale? Okay, sounds like a bird. Okay, but martingale is sometimes maybe it is something very familiar. Okay, martingale is what we call up as you lose, down when you win. Basically, what this means is you double down. Okay, and this is a very popular what do you call that strategy when people are gambling, and also unfortunately also very popular in the equity market. Okay, so what is what do you call it when you're in gambling? This is called doubling down. That means how does it work? The sequence is the 1, 2, 4, 8. That means if I lose one unit, if I lose one, the next bet I put is 2. If I lose that 2, I'll put 4. A lot of people are very familiar with this. Okay, some of them use it as well in situations of wagering money, right? And in stock market as well, this is called averaging down. All right, so averaging down can be useful in certain types of strategies. Okay, but in trading and all that, if your strategy of position sizing is basically to up your risk as you lose, then this is a very dangerous situation. Okay, this is what we call a flawed method. Okay, and indeed this is a recipe for disaster. Okay, a lot of people have tried it. Okay, a lot of people instinctively do it. Okay, because they feel that when wagering money, it's like that. You double down every time, double down your bet. Okay, and actually for trading, it's not recommended. Okay, what is recommended is the anti-martingale system. What is anti-martingale? Okay, basically what you saw those guys do, the A, B, C, D. Okay, especially you saw the person B with the 25%. Basically, he was doing the anti-martingale. Okay, so as his balance of his cash increases, okay, every time he bet the 25%, actually the bet will be larger. Okay, so you increase your trades or increase your exposure only as you make money and only as your equity or your balance increases. Okay, and if your balance goes down, then you reduce exposure. Okay, so basically the principle is increasing exposure on profits, and this concept is for geometric growth, or what you can achieve with this is geometric growth. Okay, so basically you'll be earning more profits as you continue to trade and as you continue to increase the size. Okay, so this particular anti-martingale system basically it tries to strive for the greatest economic profit. Okay, and this is optimal for trading. Okay, this is the recommended way to position size, which is the anti-martingale. Okay, so let's look at some of the strategies. Okay, I'm going to show you this fixed fractional position sizing method. Okay, or otherwise well known to be called the 2% rule. Okay, and this is one of the most used sizing methods by professional traders, okay, especially professional equity traders. Okay, and what is the concept? The concept is a fixed fractional to limit your losses. Okay, basically you every time you trade you have fixed risk amount risk in every trade. Okay, so basically professional traders commonly limit their risk to only 2% of their account balance on any trade. Okay, whatever exposures they have, okay, they only limit every trade to a 2% account balance. Okay, later we'll see how this is done. Okay, so in terms of using the fixed fractional position sizing method, okay, you need to know two terms. Okay, especially this term called the individual trade risk. Okay, that means and every single individual trade, okay, basically is the dollar divided the dollar or the ringgit amount of risk taken per trade. Okay, so you need to know what is your ringgit exposure or ringgit risk per trade. Okay, and after that, that will determine, okay, the number of shares or the number of exposure of amount of your capital that you put at risk. Okay, so let's see how that works. Okay, so in terms of that, this is an example of application of the 2% rule. Okay, so this on the left side, you already know I defined it already. But let's see, example, if you have an account balance of 20,000, okay, doesn't matter, it can be any amounts of risk capital that you put. Okay, so and say you system limit, say you limit yourself to 2% of account balance. Okay, you want to follow the 2% rule. So your individual trade risk, what this means is every time you risk money in the market, okay, you don't risk more than 2%. Basically, 2% of 20,000 is 400 ringgit. Okay, so if the price of that particular share is 2 ringgit, okay, and if the risk per share is 20%, okay, so this is very important. Okay, you convert your 400 ringgit, which is the absolute amount, to the share price risk. Later we'll see how to do that. Okay, if you risk 20 cents, okay, then the number of shares to buy is 400, which is the absolute amount, divided by the per share risk per share, which is 20 cents. So you buy 2,000 shares of this particular stock at a particular price. Okay, so we will see how to calculate that. Okay, so this is the example we'll do. Okay, and in order to calculate position sizing, the beauty of it these days is there are a lot of free resources on the internet. Okay, I'll show you one link that you can use it. Okay, and you can actually basically key in your parameters and it will calculate for you what sort of exposures to buy a stock. Okay, let's say for example, in terms of we will see in the next couple of pages. Okay, a free resource where you can actually calculate your position size. So in terms of this particular portfolio of 20,000 ringgit with a risk percentage rule of 2%, okay, and buying a stock at the price of 2 ringgit with a risk per share of 20 cents, you will buy 2,000 shares. Okay, if it seems a bit complicated, don't worry, we'll see the formula how it works inside. All right, so let's move on. Okay, so we will be using the fixed fractional money management system. Okay, so let's see how it's done. Okay, and this is something that we did the previous time. If you remember, April 13. Okay, we look about the ABC trade signal. Okay, and we spoke about this particular thing, the stop losses. Okay, stop losses are where we define the risk technically using this particular system. Okay, and we have the stop losses either A or C. Okay, I wouldn't spend too much time on going through the trading signals. You can go back to that particular session to review that. Okay, but what we basically said is you can choose if you buy a stock, say at the price of B, you can choose to put your stops at A or at C. Okay, so we'll apply that, actually implement that in the system. Okay, so this is a my EG, this stop my EG. Okay, in this case study, the time between June to November 2021. Okay, so based on the ABC system, you have a buy signal over here, which is at 86 cents. Okay, and actually here, so you saw here there's this bullish divergence. Okay, so when you buy at 86 cents, then where is your stop loss? Okay, so based on the ABC system, your stop loss is actually, okay, either at C or at A. Okay, so this is your buy point, 86. Your stop loss is below 79.5 cents or at 77.5 cents. Okay, so these are your defined stop loss. So basically, using the ABC system, you know where your stop loss are. Those are the risks that you're taking. Okay, and that particular per share risk is actually where you put in to count the amount of shares you buy. Okay. Okay, let's move in and look at this. Okay, so this is a free calculator that I've been using. Okay, this is the reference is chartyourtrade.com. Okay, there's a position size calculator over here. So this is the format that you will see if you go into that page. Okay, chartyourtrade.com. Okay, I'm not affiliated, or I don't own this particular website, but I find that this one of the more convenient ways, more convenient calculators available. Okay, so basically what you do is you key in your capital. Okay, so just now we said that we have 20,000 capital. We key in the capital. Okay, we key in the percentage of account value we are willing to risk. Okay, we say that already 2%. Okay, that's what we're willing to risk. Okay, and then you look at the entry price. Okay, what is the price of the share? This time was 86.5, right? If you go back, or 86, so basically buy it higher slightly, 87. Okay, where is your stop? Okay, protective stop. And this particular stop, okay, I want to share with you, is basically this stop is at where's the 77 stop? If we go back up, okay, 77 stop is at A. Okay, so basically 77 is below the 77.5. Okay, we are putting a stop at A. Okay, so we put a stop at A, which is 7 cents. So our risk per share is how much? Okay, from the entry price that we want to buy 87, and our initial stop loss, it is a 10-cent risk. Okay, so once we put it into that, we press compute. Okay, when you put this, automatically compute for you, the number of shares to buy is actually 4,000. Okay, so you buy 4,000 shares at 87 cents. Okay, your position size will be, actual amount will be 3,480. Okay, and your basically that's your risk per share is 10, and your risk amount is 400 ringgit, which is actually 2%. Okay, so that's how you calculate it. Okay, I give you another example. Okay, so this is if you put your stop loss at C, which is at 79 cents. So this is a tighter stop. Okay, so your risk per share now is only 8 cents. Just now was 10 cents. Okay, so when your risk per share is lower, of course you can buy more. Okay, you can buy 5,000 shares. Okay, so if you key in the same parameters, but now your initial protective stop, this is where your risk stop is at 79. Okay, then you will have a position size of 4,350 ringgit worth of shares. Okay, risk is 8 cents. Okay, but your risk is still 2% of your total account size, which is 400 ringgit. Okay, so the tighter the stop, of course, you can have in terms of the ringgit value of your exposure, you can actually buy more shares. Right, so that's a difference in terms of how you implement the ABC system using this position sizing calculator. Okay, let's go in and look at another example. Okay, this is Gamuda from February to May of 2022. Also, a buy signal created by ABC. Okay, and the buy signals, the B is 305. Okay, and we'll buy slightly above 305. You have a choice between a sell stop loss at C or a sell stop loss at A. Okay, so let's go in and take these numbers and calculate it. Okay, so we put it in the system, and this example, same thing, 2% risk, stop loss at A. Okay, so we are saying that we want to put the stop loss at A, which is at 275. Okay, so we key in. Now we have a capital size of 50,000. We change the capital allocated. We have 50,000. Okay, percentage of account willing to risk is still 2%. Your entry price is 310, okay, slightly above just now the entry price, and your initial stop loss, this is A, is below A, which is 275. Okay, so if you press compute, you automatically will compute this for you. okay, you should buy 2,857.1. So you round it up to about 2008, okay, be a bit more conservative, round up to 2008, okay, and basically your risk, your position risk is 2%. 2% of 50,000 is 1,000 ringgit, which you see reflected over here. Okay, obviously, if you to go the stop loss at C, which is a tighter stop loss, okay, less individual per share risk, you actually buy a bit more shares. Okay, so your position size become above 10,000. Okay, compared to the previous one. Okay, so but the risk you take is still the same. It's still 1,000 ringgit. Okay, basically this one is rounded up. Okay, so instead of buying this now, what was that? This now was 2,800 shares. Now you can buy 3,300 shares. Okay, so it depends on the risk that you take. If your risk is less, then of course you can buy more. Okay, so in that sense. So what if you risk 1%? Just okay, you're getting too vertical. If you feel that you want to be even more conservative, okay. Sometimes also you cannot be too conservative. You must risk enough, okay, but not too much. Okay, 1% is extremely conservative. Just to give you an example, okay. So if you do that, of course, now you buy 1,004 shares lah for this same scenario over here. Okay, with the stop loss as A. Okay, so it's very conservative. Okay, so you need to balance out. You too conservative, also probably your account size wouldn't grow. Okay, but too aggressive as well. You saw in the game just now that if you become too aggressive, you will actually has a chance to blow your account. Okay, so this is how you implement in terms of the money management using the fixed fractional method. Okay, so in terms of in conclusion, okay, we'll take questions afterwards. In conclusion, okay, money management guidelines for trading, your first and most important is to preserve capital. Okay, this is the key important thing in trading investing. Okay, always trade with a stop loss. That's the key point. Risk no more than 2% of your trading capital on any trade at one time. Okay, remember to calculate your win-loss ratio so you know whether your system has a good system expectancy. Aim for 2 or more. Okay, use position sizing. You saw the reason why you must use position sizing. It actually can maximize your results better in terms of returns. Okay, and keep records. I think one thing I advise is always keep records, okay? Because without trading records or numbers or data, you cannot analyze your trades, okay? So in terms of trading statistics, what price you enter, okay, you can always transpose all those records from your broker statements and put it into Excel spreadsheet, okay? So with trading log or keeping a record, you know how you're feeling at the time, why you made those decisions, okay? Many traders don't like to do that. They say, oh, so mafan, they say, you know, so inconvenient. But honestly, if actually you do that and you go back and you're able to review your trades, it gives you very valuable insights, okay? And of course, it gives you a lot of data you can use in terms of measuring your trading system. Okay, so let's move on to okay, there's a few more slides, basically monitoring results. Okay, we emphasized on that already. I will not belabor too much of it. Okay, so how to do it is, of course, you record all your trades. Okay, and then you find what's your average profit per winning, average loss per winning, per losing trade, what's your payoff ratio, measure your equity drawdowns and all that. Okay, so in order to do this, you can also, interestingly, also have all these free resources on the internet. If you check out, what do you call that? They even give you free Excel spreadsheets to calculate, to monitor your statistics. Okay, so go on and get on those and put in your data. Okay, so the main objective of trading is basically win more trades than you lose and have the profits and winning trades larger than the losers. Okay, so that's a summary in terms of money management and position sizing. Okay, so the cumulative effect of doing that is your pot of gold. Okay. So I'll leave you with this Shunzi, The Art of War. Okay, chapter 4 basically is about putting yourself beyond the possibility of defeat. I will not read the whole thing. Okay, but basically what it says is this: you can always put yourself beyond the possibility of defeat and then give the market or let the market give you the profits. Okay, so by playing smart and playing good tactics in terms of your risk management and also your position sizing, the market will be the one that actually be rewarding you. Okay, basically that's the enemy giving you the victory. Okay, so this is a very important chapter which I find very useful in terms of the art of war. Okay. So yes, so back to you, Shane. We're going to take questions now. I hope it has been a good session so far. So Shane, back to you.
Thank you so much, David, for sharing with us, money management and also position sizing strategies. So now that we have learned a great deal into how we can systematize our trade and create a winning system for ourselves. All right. So if you have any questions to ask our speaker today, David, please write them at the Q&A box, not the chat box. Okay. Q&A box. So in regards to your formula just now, Izzat would like to ask, how do you get risk per share? Is there any calculation?
Oh, okay. So your risk per share is basically okay. I use the ABC trading system to show you where the stop loss are. Okay, so basically, if you go back to where my strategy is, I know where are the technical stop loss. Okay, so that's why I know where my risk per share I'm taking for that particular stock. Okay, now in terms of if you don't have a particular what do you call that method, okay, I'll encourage you to have a method that you can define that particular loss. Okay, so whether it's through a technical trading sale or whether through research reports we say that perhaps at a certain price already the stock won't be performing, then you will know your particular risk for that particular trade. Okay, so it depends on the system that you use to trade. Okay, so in terms of looking at my technical system, where I define the stop losses are, that's where I get the risk per share. Okay, after that you will use that risk per share to calculate your exposure. I hope that helps.
All right. Fatima would like to ask, in terms of percentage of risk, does it include the brokerage fee? Do you take that into calculation?
You can, all right, because that is defined as basically slippage. Okay, so those are cost of trading. But I think these days the brokerage is so competitive. Okay, compared to your returns, it could be very minimal impact lah. Okay, unless you're a very active day trader. Okay, in day trading, of course, that will have a significant effect because you're looking at very high volume trading. Okay, so in terms of brokerage, I think that won't be a very big consideration because these days the brokerages are very, very competitive. I hope that helps.
All right. Thank you so much, David. So, Plessis would like to ask, how do we know where to put the protective stop loss? How do we evaluate A and C or what?
So you need to have a system. Okay. Okay. So some people define the stop loss by the value. Okay, you can of course define the stop loss by the value. Okay, so let's say for example you can do it this way where you say, okay, I have 50,000 to trade. Okay, so let's say I'm more aggressive lah. I'm not the 2% guy. I'm a 5% guy. Okay, so I'm willing to lose say what do you call that out of the 50,000 I lose 2,005, okay, on any trade, right? So you can basically, because you don't have any defined strategy, maybe at the time that you buy a share, say for example, you bought a share at 1 ringgit, okay, then from there you will say, okay, how many shares you bought at 1 ringgit, and you can define actually what point will be your 5,000 loss, okay? So that is the threshold. Below that, you need to put your stop loss already. Okay, because 5,000 is your 5% rule. Okay, you put that stop loss. So if that stop loss is 25% or 25 cents, okay, then it will be 75 cents is where your stop loss is. Okay, so that's another way to calculate it if you don't have a technical system or a trading system where you can define your actual stop loss. Okay, so you calculate back from your entry price.
All right, thank you, David. Isa had this follow-up question. In regards to the risk per share, is it similar to risk to reward ratio?
Risk to reward ratio is a statistic that okay, let's say for example just now your per share risk is 10 cents. Okay, of course, objectively, if you want to have a good, robust system, your system should be able to return you 20 cents on top of your 10 cents. So you risk 10 cents, you should be able to, hopefully the system will give you 20 cents. So your risk reward ratio is that. Okay, so let's say, for example, potentially in a particular chart, you may be able to see that, say it bottomed up. Okay, and this is particular risk that you take. Okay, this stock maybe can go up 20, 30, 40 cents. Okay, from your entry. Okay, so if it goes up by 20% and your risk is only 10 cents, okay, then your risk reward is 2 to 1 because your expected gain is 20 and then your risk is 10. That risk reward is a calculation of your profit against your risk that you take. Okay, I hope that explains what's the difference between risk per share. Okay, but of course, risk per share is related to your risk reward ratio. Okay, the reward side is how much profit can you make from that particular move in the market or for that particular trade that you do. I hope that answers Isa's question.
Yes. Charlie would like to ask this next question. Do you believe, trading is actually a zero-sum game?
As cruel as it sounds, as I honestly, I believe so.
You believe so, huh?
Yeah,
so
some people may not share the same what do you call that, view, okay, but to me, I see it that way. Yes, it's very, very cruel, very, very absolutely capitalist way of putting it. Yes, I see it that way. And
okay.
Yes.
So that's why we must always continuously upgrade ourselves, educate ourselves, so we'll be able to beat the market. So yes. I want to congratulate all of you who show up at our event today.
You know how much the ignorant fella like me during my 20s gave to those more seasoned traders. Very painful, actually. Yeah, nobody will know your pain, but some of you may share the same pain as me. Yeah, but don't give those guys lah. You take from them lah. That's okay. The purpose of education.
Okay, so our goal today is to make sure that we can take from them. Okay, yes, instead of donate to them. Okay,
correct.
So that's why we do this webinar to educate you. All right, so Philip would like to ask the next question. Say for 30,000 starting capital, do we need to adjust the capital allocation for the next trade? Like if we earn or we lose,
Okay, let's take the example, your illustration 30,000. Okay, so 30,000. Say you implement a 2% risk. Okay, 2% risk, 30,000. How much is that? 600 ringgit. Okay, now let's say, for example, you made 2 to 1. Okay, so you made say you made 1,002. Okay, you risk 600, you made 1,002. Very good. Okay, so your account size now is 31,200. Okay, so what's 2% of 31,200? It's more already, right? It's more than the 600. So the next time you risk, you could have a size that's slightly bigger, right? So as you move on, your 30,000 become 50,000. Okay, when it's at 50,000, then your 2% is actually 1,000 ringgit. So you can risk more already. So you can see your size of trading and exposure continues to grow as you make money, right? Now, what if you made a string of losses and now from 30,000, it becomes 20,000, right? So 2% of 20,000 is 400. So you see from your initial 600 risk is now 400 risk, okay? So in terms of position sizing, you want to reduce your size of exposure as your what do you call that? Your account size reduce, okay? A lot of people actually, when the 30,000 become 20,000, at 20,000, they are even more aggressive than when at 30,000, okay? So that is a long term, okay? There's a chance of having an accident is very high, okay? So you have one bad trade, that's it, okay? So those kind of strategies are dangerous in the sense that it's not sustainable, okay? There are times that you're lucky, then you look great, okay? A lot of people look great in 2020, right? No matter what they did, they couldn't go wrong. In 2021, the story was totally different, okay? So money management and risk management is key. Those who survive 2020 and kept the profits and continue to able to have some very good trades in 2021, and this year may be a bit challenging, but your good times may come soon, okay, in the next couple of months. So do you have the capital there to trade those moments? Okay, so that's key. I hope that answers your question.
Yeah, certainly. Now, David, just now you recommend that, as a trader, we should use anti-martingale strategy. So how do you apply anti-martingale strategy in your position sizing system? Like, do we initially risk 2%? Then if you're in a profitable trade, we risk 3%, 4%?
Okay, so your let's say you adopt a 2% rule, okay, and say that you like the 2% rule. That's, you feel that it's a comfortable risk for you. Some 2% is like, come on, 2%. All right, it's like, okay, I do the 5% thing. A lot of people say, even 5%. Some people complain it's too conservative. Okay, some people may risk. Okay, the thing is this: if you're a professional money manager, okay, a lot of professional money managers, when they're managing those huge sums of the billions, they'll tend to be more conservative, right? So those who have a smaller account size are the aggressive ones, because boba, they say no meat, 2% no meat. Okay, so okay, say in your mind, you say, I want to do a bit more aggressive. Okay, you say, I'm not professional manager, I say I do 5%. Okay, so you saw this now in the calculator. When you do 2% and 1%, right? I show you one example where we flop down to 1%. Basically your position is half. Okay, instead of buying 2008 shares, you are buying 1400 shares. Okay, so the thing is this: if you do at that time was a 50,000 portfolio, right? So when you have moved, say, to 60, or say, okay, to make it easier, 100,000. Okay, 100,000, if you meet the same situation again, instead of being able to buy 2008 shares, you'll be able to buy 5,006 shares already. So you actually have sized up already, right? So assuming from 50,000, you already build it to 100,000. Okay, so the next time you make the same situation, buying it at 87, and you will be actually double the size already. So in terms of position sizing in the anti-martingale, when you put it into that model, the fixed fractional is naturally an anti-martingale method. Okay, it will already calculate it that way, revealing to you what is the actual size. It will increase for you if your account size is larger, or it will decrease for you if your account size has gone smaller, right? So in terms of fixed fractional, it is already an anti-martingale system. So that anti-martingale is actually the principle, okay, that you only increase your exposures if you continue to build your size of your portfolio. Okay, back to you, Shane. Hope that helps.
Thank you, David. The next question is, if we have high risk tolerance, so what is the optimum percentage of account, the risk to take? So if for recommended for the high risk taker, 10%?
Depending on your system expectancy. Okay, the higher you go, okay, of course, during the good times you will be good, but you basically increase your chances of you increase this number. Technically in trading we call it risk of ruin. Okay, so risk of ruin is a very technical. You can read about it. Okay, this type Google risk of ruin. Okay, they are optimal amounts. Okay. As you can see from just now, when you saw the 25%, okay, 25% is actually a formula for certain types of risk taking. Okay, that's actually called the Kelly's formula. 25% is actually Kelly's formula. Okay, which is very aggressive. Okay, and most people who are in money management, talking about management, they will know that Kelly's formula is way too aggressive. Okay, so if 25% is way too aggressive, okay, and the opportunity to hit a string of losses, okay, if you have a streak of losses, 3-4 losses, bye, okay, you're out. That's why 25% is very aggressive. Okay, so you need to see whether your trading system, if your trading system win percentage is good, or your win-loss ratio, that means when you win a lot, say 10 times more. Okay, and these are figures that are very dynamic. Okay, so in that sense, that if you feel that 2%, 5% is sort of conservative, okay, and if you want to expose more, it can, if your system numbers are good. I mean, if your system is robust, okay, so you have to test that. Okay, so straight off, it's very difficult to say whether that's the best, but of course, through a rule of thumb, 2 to 5%, you will rarely go wrong. Okay, but you may not build it as fast as you want. Some people are more aggressive, right? So it will depend on the system. So it's not so straightforward and say that, okay, 10% is better or less. Okay, 10%, maybe some people even conservative. If your numbers are very good, you have a very high win percentage, and you have a very high win-loss ratio. Okay, so those numbers need to be taken in consideration as well. I hope that gives you a place to start thinking about how you can, even by increasing your exposure, but your other numbers need to be good. That's what I'm saying.
Okay, in this regards, right? I think just now you show a scenario whereby there are there are 4 options. One taking 10%, 25%, 40%, 51% chance, and the optimum level looks like it is 25%, if I'm not mistaken. So, is it always the case that 25% always deliver the optimum results?
For a system that's 50-50 and risk reward ratio is 2.1, that will give you 25%. Because that's when you plug that into Kelly's formula, you will come up with 25%. If your numbers are different, okay, you plug into Kelly's formula, it may not come out as 25%. It can be less. Okay, so a lot of systems were based on Kelly's formula the time that it came out. Okay, because that seems to be very interesting, right? So, but it was modified to be less aggressive. Okay. And those of you who are interested to look at it, just Google Kelly's formula, money management, and you see the whole debate. Okay, Kelly's formula had been debated for the last like how many years? 40, 50 years. Okay, but it is a formula to get you started to understand why position sizing is so important, and that's why Ralph Vince put that particular example in his book. Okay, it basically shows you that a lot of things, if you know you can position size, a lot of magic you can do with your portfolio. Okay, so check it out, Kelly's formula, and type in with the word money management and see what's the debate about. Very interesting.
All right, thank you, David. The next question is by Rose. Would you be able to clarify the capital allocated for MyEG and Gamuda varies between 20,000 and 50,000 respectively based on your case studies presented? Do we always vary the capital allocated, and on what basis to vary them?
Okay. The only one basis there. Okay. The 30 and 50 was arbitrary. Okay, I basically chose it out. That will depend on your pocket. How much money you have pocket to put at risk. Okay, so that was example to show you, if you have 50,000, okay, and you are buying Gamuda, then that would be the exposure. Okay, so it's a figure that I plucked out from the sky. Okay, so to show you example of what will be the calculation. Okay, so that particular account balance will be your trading capital. Okay, so that particular allocated funds is what you allocate for trading or investing. Okay, so that is the sum. Okay, so this entirely depends on you. Okay, so what's your risk capital? I hope that explains. It's not a special formula 30 and 50. Okay.
Okay, the next question is by Plessis. How should we diversify when our capital is low?
Okay. So how to diversify? Okay, now in terms of doing position sizing, if you have adequate capital, it's a lot easier. Okay, because if you say, for example, okay, let's say you want to diversify into 3 sectors. Okay, we don't want to put everything in one particular stock. Okay, so we say, okay, these 3 particular stock at one time, let's say if I'm invested fully into these 3 particular stocks, okay, the amounts of risk that I take with these 3 stocks shall not be more than 5% of my capital. Okay, so that principle that you should not risk more than 2 to 5% is always there. Okay, but you split it. Okay, let's say, for example, one very simple way, although not the best way, okay, to split it is, okay, so 10,000 each for each of the stocks. Okay, may not be the best way, but a very simple way to do that. Okay, so 10,000 times the 2%, 200 ringgit risk for this particular stock, 200 ringgit risk for this particular stock, whatever you allocate that risk among those. Okay, but the better way, of course, we will see the entry prices of that particular stock. Okay, you don't necessarily buy the stock one shot, one button you press for 3 stocks, right? So you may buy it in a sequence. Okay, so out of that particular sequence, if it's within your allocation, say, okay, say stock A, okay, if you have bought a certain amount, okay, you are supposed to trade 50,000 your capital, 2% is 1,000 risk. Okay, you divide it out among those 3 shares. That means out of those 3 exposures, you should not have more than 1,000 risk in the market. That's how you diversify. Okay, so you basically split it among the 3 stocks that you want to so that you don't have one particular stock in one particular sector, for example. All right. I hope that helps in that question.
All right, thank you, David. The next question is by Charlie. Whether in trading or gambling, do we have a 50-50% chance of winning or losing?
Okay. In trading, in gambling, okay, perhaps in the long term you have a 50-50 chance, but usually less. Okay. So if you're gambling in an establishment, okay, that means places like, you know, they offer this kind of games, okay, the establishment or the house will have the advantage. So you will definitely be less than 50% for you. Okay. Now, if you have a situation where you are trading, okay, your system will tell you whether your system is a 50-50 system or a 60-40 system, okay, based on your statistics, okay. And it doesn't need to be 50-50% to win. It can be less, even that, okay, or it can be more, which is advantageous, okay. So a lot of traders may have especially those who trade long-term trends, okay, long-term trends, because they hold a position for a long time and take a big profit, okay. That means their win-loss ratio is very terror one, it's more than 2-1, and probably in the terms of maybe 3-1, 6-1, that kind of thing. But their percentage of wins is less. Okay, they may be trading a 30% system or even less than 40% system, yet they are very profitable. Okay, so in terms of trading system, it may not necessarily be 50-50. If you feel that 50-50 is actually the threshold, no, it can be even less than that and still be a winning system. Okay, of course, the higher the percentage win is, of course, always in favor. Okay, but not necessarily so in terms of a determinant to whether a system makes money or not. Okay, so it can be under 50, it can be 50-50, it can be 60-40. Okay, but the very important other determinant is either the profit factor or the win-loss factor. Very important. So you can even have a 95% system that can lose consistently. Why? Because when it makes very little, a lot of times, okay? I'll say 100 times, this is 95 system. Okay, 95, I've traded some of those systems before, you know, honestly crazy. Yeah, in the FX market, okay? They make 10 pips, okay? Let me talk in FX terms. Every pip, they make 10 pips, okay? But when they lose 600 pips, okay? So you may win 95% of the time, but that 5% time you lost everything, okay? So it doesn't mean that a 95% winning system, win percentage is actually the holy grail. No, you also depend on your win-loss ratio. Okay, so always consider the other part, which is the profit factor or the win-loss ratio, as a very important determinant other than this percentage win. Okay, I hope that answers, long answer to a short question, but I hope that elaborates what I wanted to say.
Certainly. So that sounds like, you know, martingale system performance, you know, 90% winning probability, but one time lose, you know, you wipe out your entire equity.
Well, a lot of promises have been made on the internet with that kind of system. Too many.
Okay, so we have to be careful when it comes to picking system like this, you know, not to be blinded solely by the winning probability, but also you know, just more importantly is the positive expectancy. Okay, how high is it? Okay, so let's say the 2% strategy works. Will you increase your position and put a trailing stop? So that is by Izzat.
Okay, the trailing stops is, of course, a very good strategy. Then what the trailing stop does for you is it maximizes your profit. Okay, so it will improve the other part of the equation, the reward side. Okay, that will improve your win-loss ratio. Okay, so now every time you put a risk, okay, and we say, for example, it moves up to a certain point, you cannot be again putting your stop loss at below losing. So one of the other tenets of trading is never make a winning position turn into a losing position. Okay, so a trailing stop is absolutely one of the very good strategies. That means you move up the stop. Okay, so first risk you took was the 2%. Okay, so now you are in a profit. You don't need to be putting your stop still at this now at 77 cents, 10 cent loss. You can always move it up. Okay, so that way you maximize and you ride your way all the way to whatever that particular move will show you. Okay, so trailing stops is a great way to improve your reward side of the picture. Okay, certainly once you have moved above a certain profit, you should not be putting your stops at the loss. You should be either break even or continue to trail it, so that you don't end up a profitable position become a loss position.
Yeah, heartache.
Oh, very heartache.
All right. For that, just like I mentioned about Kelly's formula, right? So there are people who want to ask how to spell that. Is it Callies or is it Kelly?
This is Kelly, K-E-L-L-Y. K-E-L-L-Y.
So we Google Kelly formula.
Yeah, Kelly's criterion or Kelly's formula.
Kelly's criteria, Kelly's formula. All right. So the next question is not about stocks, but since you are also an authority in the futures market, so what is your opinion about the current FCPO market in terms of trend? This is by Ashraf.
Thanks, Ashraf. So trend is what trend? The next 5 minutes, the next 10 minutes, or I trade the next half an hour. That's my trend. So the thing is this, okay. Thank you for that question. Okay. Of course, CPO has been very, very volatile. Okay. The next trend, it depends. I'm a day trader. Okay, most of my trades are in and out within an hour. Okay, so to me, I trade volatility. I trade the day volatility. Okay, but in terms of trends, okay, it's very how to give you a true answer unless I give you a chart. Okay, but I think you may be seeing some sort of a short-term upward move, okay, after that big correction downwards. Okay, whether he has found the bottom, nobody's sure yet. Okay, what we have to monitor is still very volatile. Things around the world are still very unsure. Okay, depending on what time frame you're trading. Okay, there's no comprehensive the answer because I don't know what is your time frame. Okay, but in terms of the next couple of days, you may see a corrective move upwards in terms of the I'm basically looking at hourly charts. Okay, you can see some upward move. Okay, but in terms of volatility, be very, very careful. Of course, the day volatility is just so incredible. Okay, but most important thing now in terms of looking at trading your CPO is the risk. You need to be able to take that risk and the volatility. Okay, so in terms of a quick and easy answer, as my view is, I'm looking a bit of correction on the upside the next couple of days. Okay, but hard to say. I may be wrong, but honestly, I'm a day trader, so my time frames are way very different. Okay, after my trade is done, or after 6 p.m. I don't even trade the next session. Okay, at 6 p.m. I'm done. I do my things. I have my nice dinner. I do the nice webinars to you together with you guys. Okay, so I'm a very short-term guy. Okay, so well, that's my opinion for next couple of days.
All right, thank you so much for sharing your outlook. All right. So just now you talk about 2%, 1%, 5%, right? So for 2%, right, do you consider that for 2% risk taking? Do you consider that moderate risk taker profile, or or 1% is for conservative? What do you think?
2% would be I would consider conservative. Okay,
2% is conservative, lah.
Yeah, 2% is conservative.
How about moderate? For moderate.
Moderate 5%.
5%. So anything above 5% is aggressive.
Yeah, in a very superficial way, aggressive. But again, I say depending on the rest of your numbers in your system.
Okay, I understand that. So of course, for new investor, you recommend using 2%.
Start with that. Okay, until you find your numbers. A lot of people don't have numbers to judge. Okay, so if you don't have numbers to judge a trading system, then go on the conservative side. Okay, so once you get the hang of it, okay, and then you've notched up some numbers where you can say, hey, my system is pretty good. Okay, so I can afford some risk. Okay, now in terms of looking at other the fixed fractional is only one way, okay? It's not the holy grail, okay? But it's a one popular way to do it. There are other money management systems that may be more aggressive, okay? So one of the books I hope to recommend to you, but it's a very difficult read, okay? But extremely good book, 400 or 500 pages of read. Check out this guy, Ben K. Tarp, okay? He is the so-called guru of position sizing, okay? VANK.THARP, Van K. Tarp, okay? Yeah.
Van K. Tarp.
Yes, Van K. Tarp, position sizing. He is, if you want to read, that is the Bible on position sizing, okay? So that is good. Can put you to sleep. A lot of mathematics, but very good. Very good.
Of course, so if you love mathematics, please do buy the book.
Yeah. In that book, he will criticize and give you all the pros and cons of all the methodologies available. So that's the beauty of this particular book, okay? Wow. If you have fixed fractional, he'll give you the pros and cons. You have, say, other types of fixed ratio or whatever, or even Kelly's criterion, he will critique and analyze it, everything for you, okay? So that may be a good way to get a view of how the rest of the other money management or position sizing systems available. Okay, that's one book you can read everything on. Okay, I highly recommend that.
Yeah, I think David, you are certainly a very, you're avid reader. Okay. All right.
Can I sleep? So read a lot.
Oh, okay lah. So books help us to combat insomnia. So if you cannot sleep, right? Read more books.
Yes.
All right. Okay, cool. So thank you so much, David, for sharing with us, uncover money management and position sizing strategy to maximize our stock return. So thank you so much. All right. So if you haven't checked out Bursa Academy, you may visit www.bursaacademy.bursamarketplace.com. So this is the one place where you can get a lot of investing resources for you to upgrade your knowledge. All right. So there are, articles, video coursework, quizzes for you to take, so you can improve your knowledge about the capital market, product knowledge, exchange information, and also the market outlook. All right. So for our next webinar, we have this topic, pelaburan saham patuh syariah. So on Friday, we will be talking about, Islamic capital market. Okay, what kind of stocks are Sharia compliant, what kind of stocks are non-Sharia compliance. All right. So it is happening on 22nd of July, 2022, 8:30 to 10 o'clock. So I'm giving you the registration link. So, as the title suggests, it is going to be conducted in Malay, all right, in BM. So if you want to learn about this, about Sharia compliant stocks, please enroll into this session. All right. So ladies and gentlemen, you just heard from Mr. David Loh, who is the managing partner of Xmodeus Trading Group PLT. So David, thank you so much for spending your time with us today to share about money management and position sizing strategies to maximize our stock return. All right. Thank you, everybody, and may you all have a good rest for the day. Bye bye.
Good night, everyone. Bye bye.